Every year, the IRS publishes a tax code that runs to over 70,000 pages. Most people read 0 of them. They hand their documents to an accountant, accept whatever number comes back, and move on. Maybe they get a small refund. Maybe they owe a little extra. Either way, they assume the system figured it out correctly. It did not. Buried inside those 70,000 pages are legal deductions, credits, and tax structures specifically designed for middle-class Americans. Not loopholes for billionaires with offshore accounts. Not strategies that require a team of lawyers and a Caribbean address. Tools that any working person with a W-2, a family, a freelance side income, or a basic investment account can use right now. Most people have never heard of them. Most accountants doing quick annual returns do not bring them up. And the IRS is certainly not going to send you a letter explaining how to pay them less. Here are 7 tax loopholes the middle class can actually use. Starting today. The first one might be the single most powerful tax tool available to a regular working American. And it is one of the most underused accounts in the entire financial system. It is called a health savings account. An HSA. Here is why it is extraordinary. Most financial accounts give you one tax advantage. Either you put money in tax-free, or it grows tax-free, or you take it out tax-free. Pick one. The HSA gives you all 3 simultaneously. It is the only account in the American tax code with a triple tax advantage. And most people either do not have one or are not using it correctly. Here is how it works. You contribute money to your HSA before taxes are taken out. That immediately reduces your taxable income by the contribution amount. In 2025, the limit is $4,150 for an individual, or $8,300 for a family. That money then sits in the account and can be invested. It grows completely tax-free. When you withdraw it for qualified medical expenses, doctor visits, prescriptions, dental, vision, and hundreds of other categories, you pay 0 tax on the withdrawal. In, tax-free. Grows tax-free. Out tax-free on the same dollars, 3 times. And here's the part almost nobody uses. After the age of 65, you can withdraw from your HSA for any reason, not just medical, and pay only regular income tax on it, which makes it function like a second traditional retirement account that had the bonus of tax-free medical withdrawals for decades. You must be enrolled in a high-deductible health plan to contribute. But if you are, and millions of working Americans are, this account is one of the most powerful legal tax tools that exists. The second loophole most people know about in name, but very few use to its full potential. When you contribute to a traditional 401k through your employer, that money comes out of your paycheck before federal income taxes are calculated. You are not avoiding taxes permanently. You are pushing them into the future, to a time when you may be in a lower tax bracket. In 2025, you can contribute up to $23,500 per year. If you are over 50, an additional $7,500 in catch-up contributions. Here's why this matters more than people realize. If you earn $75,000 per year and you contribute $15,000 to your 401k, the IRS only taxes you on $60,000. That one decision could drop you from the 22% tax bracket into the 12% bracket, saving you thousands of dollars per year automatically. And your employer may match some of what you contribute. If your employer matches and you are not contributing enough to capture the full match, you are turning down free money. Not partial free money. Free money. That also reduces your taxes. At the same time, the 401k is not glamorous. It is not a secret. But the difference between contributing the minimum and contributing the maximum over a 30-year career is the difference between a comfortable retirement and a financial emergency in your 70s. The traditional 401k reduces your taxes today. The Roth IRA takes the opposite approach. And for many middle-class earners, it is even more powerful. With a Roth IRA, you contribute money that has already been taxed. There is no deduction today. But from that point forward, the growth, the dividends, the compound interest over decades, all of it accumulates completely tax-free. And when you withdraw in retirement, you pay nothing. Not a reduced rate. Nothing. If you contribute $7,000 per year beginning at age 25 and earn an average of 8% annually, by age 65, you will have approximately $1.9 million. Under a traditional taxable account, that entire amount would be subject to capital gains tax. Under the Roth IRA, the full $1.9 million is yours. Tax-free. In 2025, individuals earning under $146,000 can contribute the full $7,000 annual limit. Married couples filing jointly can contribute with incomes up to $230,000. And for higher earners above those thresholds, a strategy called the Backdoor Roth allows you to contribute through a conversion process that the IRS has explicitly permitted. The government is essentially letting you make a deal. Pay your taxes now, at your current rate, and we will never touch this money again. For most people under 40, that is one of the best deals in the tax code. If you have children or dependents, the tax code offers direct reductions in what you owe. Not just reductions in your taxable income, but dollar-for-dollar reductions in your actual tax bill. In 2025, the child tax credit provides up to $2,000 per qualifying child under 17. Up to $1,500 of that is refundable, meaning if the credit reduces your tax bill below zero, you may receive the remaining amount as a refund even if you owe nothing. In addition, the Child and Dependent Care Credit covers a percentage of what you spend on child care or dependent care while you work. If you spend on daycare, after-school programs, or care for an elderly dependent, a portion of that cost comes back to you directly as a credit. The American Opportunity Tax Credit covers up to $2,500 in qualified education expenses per eligible student per year for the first 4 years of higher education. The Lifetime Learning Credit covers 20% of up to $10,000 in education expenses for any year of school, not just the first 4. Graduate courses, professional development, continuing education programs. These credits do not reduce your taxable income. They reduce your actual tax bill. A $1,000 credit is a $1,000 reduction in what you write on the check to the IRS. Most families are eligible for multiple credits simultaneously and claim only one or none. If you are self-employed, run a freelance business, or have any income that does not come directly from a single employer, the home office deduction can quietly save you hundreds of dollars per year. The IRS allows you to deduct a portion of your housing costs: rent or mortgage interest, utilities, internet, insurance, equal to the percentage of your home used exclusively and regularly for business. If your home is 1,000 square feet and your dedicated workspace is 100 square feet, that is 10%. 10% of your annual rent or mortgage interest, utilities, and internet bill becomes a business deduction. The key word is exclusively. A desk in the corner of your bedroom does not qualify if you also sleep in that room. A dedicated room, even a small one, used only for work qualifies entirely. There is also a simplified method. The IRS allows a standard rate of $5 per square foot of your home office, up to 300 square feet. No receipts required, no percentage calculations, just the square footage of the space. If you have any self-employment income, freelance writing, consulting, driving for a rideshare platform, selling products online, you likely qualify and almost certainly are not claiming this. This one is the most unknown tax loophole on this list, and it is arguably the most powerful for middle-income earners who have begun investing. Most people assume that when they sell an investment for a profit, they owe capital gains tax. And they do, at rates of 15 or 20% depending on income. But here is what almost nobody knows. If your total taxable income for the year falls below approximately $47,000 for a single filer, or $94,000 for a married couple filing jointly, your long-term capital gains rate is 0%. Not reduced. 0. If you earn $50,000 in wages and you have a stock position that has appreciated significantly, you can time the sale carefully, particularly in a year with lower income, or by maxing your pre-tax deductions first to bring your taxable income below the threshold, and pay nothing on those gains. This is not a strategy for billionaires. This is a mathematical feature of the tax code available to anyone whose total taxable income is below that threshold after deductions. Most middle-class investors who hold their own brokerage accounts and sell positions throughout the year are paying 15% on gains they could have legally paid 0 on. The threshold changes annually. The principal does not. 7 loopholes. All of them legal. All of them written into the tax code by Congress. All of them available to you right now. Not to billionaires with offshore trusts, but to anyone with a paycheck, a family, a side income, or a basic investment account. The frustrating truth is this: the tax code rewards people who understand it, not because the system is fair, not because it was designed with your interests in mind, but because the tools are there, documented and available, and the gap between people who use them and people who do not is almost entirely a gap in awareness. A middle-class family who fully uses their HSA, maximizes their 401k, opens a Roth IRA, claims every credit they qualify for, and manages their capital gains carefully can legally reduce their tax bill by tens of thousands of dollars over their lifetime compared to someone with identical income who does none of those things. That difference buys a house, funds a retirement, pays for a child's education. The people at the top of the income scale have entire teams of accountants and financial advisors whose only job is to find and apply every single one of these advantages. They have known about the HSA triple advantage, the 0% capital gains threshold, and the power of Roth conversions for years. Now you know it too. The difference was never intelligence. It was access to information, and that gap just closed. If this gave you something you can actually use, subscribe to the Hidden Ledger. This is what we do here. We find the parts of the financial system that work in your favor and make sure you know about them every single week.